Today, we are going to talk about the minimum statutory investment versus a required investment amount and how it affects you when you're getting a loan. Hey, this is David Xie with the Xie Mortgage Team. We all kind of know if you're watching the video and you're out there and you're looking at an FHA loan, you may have done some research and you're like, okay, it's 3.5% down, or you're doing a VA loan and it's like, oh yeah, it's 0% down. Conventional loans, 3 to 5% minimum down, and then USDA loans, no money down. And then the non-conformings have their own guidelines because they're playing by their own rules. We're going to talk about what that means and how it affects your qualification. So first of all, we're going to talk about the minimum statutory investment required. So those are those down payments that we were just talking about. So I'm just going to pull FHA out because that's one of the most popular loans. With an FHA loan, the minimum statutory investment required is 3.5% down. On conventional loans, that could be 3 to 5% based on the qualification and your home buying status. So that is the minimum statutory investment required. However, when we take your loan application in and we run it through the automated underwriting system, a lot of times as a mortgage loan officer or mortgage loan broker or anyone that's doing loans, we are constantly looking for a set of automated underwriting findings, because what that does is it gives you a way easier path to getting the loan. What that means is when it comes out of the automated underwriting system, if we've input all the information in there correctly, we will just have to go down that list and get all the required documents from you so that we can get the loan approved. However, a lot of times we have to manipulate the loan based on credit score, loan to value, debt to income ratio, and this is where your required investment amount comes in. When we run the file through automated underwriting, it's being calculated by DU or LP, and that's desktop underwriting or loan prospector. What that does is it's taken everything into consideration and it's going by their guidelines, and it tells us if it's comfortable giving you an automated approval or one that will require an underwriter to sign off on it. It constantly changes, like, I would say every month, every couple months, every couple weeks sometimes, they do some enhancements to it. And it'll adjust based on your closing costs, your prepaids, how much the seller is going to be paying for you. And it looks at every single component of the loan and it dials it in and it says, okay, based on this qualification, we may need this much cash reserves in order for us to close. And that's where, it comes down to, okay, after you put your down payment down, how much do you have to have as a cash reserve in the bank? And most of the time on these manually underwritten loans, and that is a loan that has been run through DU or LP, it comes out and it says, hey, we need to get an underwriter to sign off on it. Those cannot be using gift funds to count as your reserves. So when you're working with a mortgage lender, it's really important that, number one, they know what they're doing and they're taking any gift funds, if there are any gift funds, and using that towards down payment instead of cash reserves. They're taking the seller credits and applying it towards what's most important. And a lot of times we can possibly even just lower the rate just a little and it'll give us an automated underwriting approval, or maybe increase the reserves by 1 month and hold out for another pay stub when you get paid. And this is also true for any multifamily units as well. The other thing to really consider is when you're using your lender, whether you go into a direct lender or a bank, or you go into a mortgage broker. I've been doing this for over 16 years, and one of the things that I've noticed working for all three of those types of institutions, the bank, the direct lender, as well as the mortgage broker, is when you work for the bank or the direct lender, you really have that one underwriter who looks at everything, and then those set of investors, which is like 5 to 6 or 7 or 8. And those are the investors that they say, hey, we're going to send all of our loans to them because they're giving us the best pricing or the best overrides. However, they may have other guidelines on top of your standard VA, FHA, conventional USDA guidelines. Whereas if you go with a mortgage broker, we have a bunch of options to shop with, right? So not only are we able to save you money without the overrides that are being put in at the bank and the retail level, but we're saving you money because we have 189 different investors that we can shop with. And every investor does the same type of loans, but some have better staffing, so they may charge more for that staffing. And some have less staffing, so they may be giving you a better interest rate and cost, which in turn helps you save money. There may not be any overlays with these investors, So we would just follow the exact approval in the system. And then really the third thing is that going wholesale versus retail, you do save significant money based on 2021 HMDA data. So if you have any questions about getting a loan, have any questions about your minimum statutory requirement, or what is actually required as an investment account or amount, feel free to give me a call. Me and my team will be able to help you. We can be reached at 757-478-8493. And I'm just saying, this is David Xie with the Xie Mortgage Team. Talk to you later.